My name is Jeff Quartermaine, and I'm the CEO and Managing Director of Perseus Mining Limited. Perseus is an ASX, TSX listed gold company with all of our operations on the African continent, and we have released our half-year results for the period up to December 24 today, and look forward to bringing that news to you.
Jeff, good to see you, sir. And half-year results out. Some similarly pretty good numbers in there. Why don't you give us the top line numbers, please?
Yeah, no, look, they are very good numbers, Matt. I mean, it's based off production of around 254,000 ounces for the half-year period at an all-in site cost of $1,162 per ounce. So the profit after tax was $201 million, up about 22% on the prior period. Operating cash flow, US $248 million, up 17% on the prior period. And net tangible assets, $1.338 billion, US, that is, up 4% on the previous period. Our dividend for the interim period of 2.5 cents Australian is double the interim dividend that we paid in the corresponding period last year, so more returns to shareholders. But what's really important from our perspective underpinning all of this is that our earnings per ounce are around this is earnings after tax per ounce, $819 per ounce, which is 25% higher than in the previous period. And similarly, the operating cash flow is US $976 per ounce, up something like 20.8% on the previous period. So look, it's been a very good period for us. These are the results that have been derived from some very good operating work, delivering on our promises, production-wise and cost-wise. And it's put us in a very, very strong position to continue to generate benefits for all of our stakeholders and continue the growth of the business into the future.
Right, and where have you seen this growth come from? Because I think some people might point to higher gold price, but there's got to be some operational efficiency and production output increase there too. So where do you see it coming from?
Well, the growth is going to come from several sources, actually. I mean, we most certainly will continue to operate efficiently, and that's fundamentally important. And more importantly, perhaps, operate in a way that keeps our costs under control, which means that if we do face inflationary headwinds, we can make provision for that and ensure that our costs stay reasonably solid. So strong operating performance underpins the future for us. But I think the other thing that's really important is maintaining an extremely strong social license to operate, because it doesn't matter how efficiently we operate, if we're not welcome in our countries, given that we're operating on the African continent, then it's all academic from that point of view. So that's really important part of what we're going to be doing going forward as well. But in terms of growth, there's a number of sources of growth. I mean, one is the obvious ones that we've already announced, which is the development of the Yaouré underground mine off the CMA pit. That's an initiative that's well underway now, and we'll be having the contractor on site very shortly, equipment arriving, and start cutting portals around the middle of this year. The other project that we're looking forward to getting underway with is the Nyanzaga gold project. This is one in Tanzania, that we're looking to start development on very shortly as well. So there are two major initiatives that is well known to the market, in fact, that Perseus has been working on. And one of the other things that we're also looking to is that we're looking very carefully at our existing operations. Now, this is an interesting one, because when the pits at, say, Edikan and Sissingué were designed, we were using very much lower gold prices than what prevail today. In fact, we were using $1,500 per ounce, I think, was the latest reserve estimates that we've done. Now, when we look at these operations and we're saying, look, if we were to use a higher gold price, are there more ounces of gold available for us? And the answer is almost certainly yes. However, the caveat is that these incremental ounces come at higher unit cost. Now, from Perseus's point of view, we need to decide what's more important for our shareholders. Is it to be producing ounces at a higher cost, or is it to be preserving the unit costs across the group and maximising margin? Now, clearly, at the end of the day, this is something of a question mark around what do you think the gold price is going to be going forward. But we have this opportunity to expand our existing production base and in the process, increase returns to our shareholders. So there's quite a number of opportunities that are currently ahead of us, organic growth opportunities, which, as everybody knows, are the best form for creating value.
And with regards to this increase in the dividends, I mean, is any of that come from like one-time gains or like non-reoccurring items, or is this what we expect to see going forward from you?
No, well, look, I mean, the increase in dividends and the like is strictly related to the cash flow that we're generating. I would say that, clearly the gold price is influential in that. But what we do is at the beginning of or at the end of each reporting period, we look at the position and say, right, how much cash have we got on the balance sheet? What are our immediate needs? How much are we going to be generating in the next period? How much is surplus, and how much can we share with our shareholders, who are very, very important stakeholders? Now, what we have done in the last year or so is share it in two forms. One is through dividends, and the other is through initiating an initial share buyback. And the reason we've chosen both of these methods of distribution is that, given that we have shareholders all around the world, everybody has a different tax position. Some people would prefer a buyback as opposed to a dividend stream, in the sense that the dividends are not franked, as it were. So they see more benefit from getting a buyback. So these are things that we need to look at very carefully.
Right. And when we look at that operational efficiency, clearly it gets harder and harder to be more efficient, because it's decreasing returns there. But from each, I'm going to look at this on a project basis. Where does future growth come from? Is it a case of increased answers? I see you were describing, and the question is then getting the timing right for that, or will it have to come from M&A further down the line? You have talked about the need for expansion, maybe even outside of Australia in the past with me.
We are going to bring online the Nyanzaga project in 2027, early 2027, which is going to be occurring at a time when, without additions to Sissingué and Edikan, production would dip. So the Nyanzaga ounces automatically replaces what would be the normal depletion, as it were, of mines that have been running for a lot longer than what they were originally envisaged to be, I might add. When we started Sissingué, it was like a 4.5-year mine. Now, I think, by that time, it'll be up to about 8 or 9 years. And similarly with Edikan, it was about 10 or 11. Well, as it stands today, we're up to year 14. So, things have moved along pretty nicely. But yes, no, it's part of our planning that we do bring on new projects in order to replace depletion, because that's one of the things about mining. Every day we mine and process, we're depleting our natural resource, and we need to keep replacing it, either through exploration on our properties or through acquisition of either exploration tenements or existing companies, as it were. And all of those things need to be considered when we're looking for growth, because at the end of the day, our job is deploying shareholders' capital and deploying it in a way that generates the best benefit that we can possibly derive. Our business is not about spending money, it's about generating value.
If I look at how you go about doing that, obviously you've built up a very large cash and bullion reserve. It puts you in this very strong position when you are looking at M&A. Look at your last transaction, the fact that it was a cash deal allowed you perhaps to come out on top there. Is that very much in the back of your mind in terms of this cash reserve that you've got, or how else can you deploy that for the benefit of your shareholders?
Well, we can deploy that cash either to invest in growth or efficiency, or to return it to the shareholders. Basically, they're the basic choices. Now, we're seeking to do both at the present time. We're seeking to pay returns to our shareholders and invest in growth. Now, you mentioned the last transaction we did indeed pay cash, because it was fairly difficult for us to justify issuing paper and expanding our share base when we had such a lot of cash around. Now, we have spoken to a few of our shareholders in relation to various transactions, and some of them have said to us, well, we'd actually quite like to take Perseus scrip rather than cash, because we get the cash, we've got to deploy it anyway. So, it's a horses for courses situation. Sometimes cash is preferable. Sometimes using scrip is preferable. Sometimes a combination of the two makes most sense. But it's really about making sure that we can transact in an efficient way at a price that can be demonstrable in delivering value for shareholders.
Right. And talk to me then about, because I think businesses need to kind of focus on margin, right? Profitable businesses are better than big businesses sometimes, I would argue. How do you manage that margin, and how you want to measure it? Some people like, ASX and some others prefer all in, etc. But in terms of the way that you measure it, you've got declining assets. You've kind of got new assets ramping up. You've got to kind of I guess integrate that transition efficiently, effectively. Again, do you think you can sort of maintain the all-in sustaining costs at the current rates? Because it's probably not necessarily maybe market leading, but not far off.
Look, we're not very smart. So what we do is we focus on two things, or one thing at least. I say to our teams, we want you to produce as many ounces as you can possibly do at the lowest possible cost. If we do that, then we're doing our job, and we let we can look after the rest. Now, the fact of the matter is that there is inflationary forces at work. There's no question about that. Labour, for instance, goes up every year as people seek pay rises, etc., etc. So what we need to do is to do our best to find ways of operating in a more efficient way, so that by reducing our cost base from the operations, if there's changes to fiscal regime, it doesn't impact our overall costs. Now, that's easier said than done, and as you quite rightly pointed out early in the piece, there's a point where it starts getting more and more difficult. You've squeezed the lemon as hard as you can squeeze it, and that's all that's going to happen. And at that point, that is when you start to see some cost inflation. But look, the thing is this, I guess, in the current environment, the gold price has been rising at a faster rate than our costs have been moving. And, one of the charts I really enjoy showing people is a chart that shows a build-up in production, keeping our cost structure reasonably flat, and at the same time seeing the gold price rise. So with rising production, we've had rising production combined with rising margin, which is what's been delivering us the benefits that we have now. Can we continue that into the future? Well, I'll tell you what, we're going to give it our very best shot, and it won't be for one to try.
Right, and if you look at those, you make a point, coming back to a point you made earlier, which is about you've extended the life of mines here, and that's your job with exploration, etc. You can do that to a point, and then it becomes a question of return on capital invested. Where do you sort of see that sort of cutoff point? How do you measure that kind of cutoff point before we think, well, actually, M&A is probably going to be a bit more efficient for us here, and you need to signal that to the market, because you may see some coming off in terms of the ounces for a period of time, which you've got to manage those expectations, don't you?
You do, and I think you've got to look at all of those things simultaneously. Look for opportunities through the M&A side of things, but at the same time, look closer to home and see what you can do with your asset base. Now, the point I was raising earlier is that by increasing the cutoff grade in the design of your pits, you can certainly get more gold, but it comes at a cost, and we need to recognise that. And does it do more for our shareholders by reporting a relatively low all-in site costs, or does it do more for our shareholders by reporting more production at a higher cost? It seems it's an interesting thing, because while the gold price is rising, people don't seem to mind the costs rising a bit as well. But of course, I'm old enough and ugly enough to remember the days when gold didn't rise all the time, and that is the period that worries me, because I'm sure that day is going to occur sometime into the future, and what we don't want to do is find ourselves in the middle of a rather extravagant cutback, only to find that we're going to expose gold that's no longer actually profitable. That would be a disaster. So, that's the sort of thing that we need to think about. There are ways and means of mitigating that, of course, through using targeted gold price hedging and things of that nature. But that's also something that, some investors don't like that while the gold price is rising, but, it can actually keep you in business when the gold price is falling as well. So, look, it's something, it comes down to a judgment, really. And I guess that's what we're being paid for, is to make judgments that deliver benefits, and hope to goodness that we get it right more often than we get it wrong.
Right, and obviously out there, there's a fair bit of competition at the moment because I think lots of companies building up, these big these huge cash piles with which to do M&A, and you're going to have to find projects which you like. So whilst managing those kind of depleting reserves, you're also then trying to find the right profile of acquisition. And obviously, the longer it takes, I guess, the nearer mine production you're going to want the asset to have. Whereas if you've got a kind of long run up, perhaps you can jump in a little bit earlier, like you did recently, and kind of build that project up yourself in the way that you want. So do you see much out there that you like the look of? Because there's not too many big gold projects out there at the moment, it feels.
No, absolutely correct. In fact, our sweet spot, so to speak, is these pre-development assets that we can apply our engineering skills to and development and then operating. Now, I would say that Perseus currently owns 2 of the 3 best undeveloped assets on the continent in Africa. One is Nyanzaga, the other is Maya Sand in Sudan, and then probably the third most attractive project that is out there, albeit it's very expensive, is Spancan in Guinea. So, we've already put our foot on 2 of the 3, and that's, stood us in good stead for the future. But look, it is difficult out there, and it gets to a point where it probably makes more sense to hold fire and sit on your cash for a little bit longer than join the rush, because at the end of the day, you've got to make a return on investment. And I think one of the things that a lot of investors perhaps overlook is that a lot of people in the broking community and in the job of promoting stock talk about these projects on a 100% basis and say, look at the economics on this, terrific, 100%. Now, the fact of the matter is that in Africa, in most jurisdictions, the government takes a carried interest of sorts, whether it's 10%, 15% or 20%. So at best, you're getting 85, 80% of the actual cash, even though you've invested 100 cents in the dollar. Now then, if you actually fund that project through intercompany loans and you get your money back, then the only way you can actually extract cash is through dividends. And then the government charges you 15% withholding tax on all dividends. So in a case where we own, say, 85% of one of these projects, we start off thinking we'll get 85% of the cash, but then on the remaining 85%, we're only getting 85% of that in any event. So if you do the maths, you find out that you're investing 100 cents in the dollar and you're getting 70 something or other cents back from that. And, put that into your economic analysis, particularly if you add in the acquisition cost, and you need a lot of gold at very good prices to make a reliable return on your investment. So, for us, the task, as I keep saying, is generating good returns on shareholders' funds. It's not that easy, and you've got to kiss a lot of frogs, as they say, before you find your prince. And I can tell you, we've been kissing madly of late, and we still haven't found too many of those princes out there.
It's interesting, actually, when you look at some of the analysis, and I used to be guilty of this, is, people don't even factor in things like recoverable and payables in there, and the cost of capital, etc. There's a lot of dilution, shall we say?
I love the analysis with 5% cost of capital. If anyone can show me 5% cost of capital, and in Africa, please I'll give you my phone number.
Right. Okay. Well, obviously, we've talked a little bit about the projects themselves, and that kind of expansion process you've got to go through, and kind of Nyanzaga, how that kind of comes into the fold in terms of production fold anyway. But now we're looking at this kind of M&A potential. You have said to me in the past, in terms of like you've got all this African experience, and there's varying degrees of, I guess, discounting of your stock potentially in terms of value, in terms of etc. Because people don't necessarily understand entirely Africa or some of the jurisdictions in Africa. You have talked about looking beyond Africa. Is that partly to kind of counter that kind of risk profile that you have, or
about that, Matt? I mean, that's a theoretical proposition. I mean, if you can't find anything to do, then you may well look further afield. But we've got no intention of looking further afield right at the present time. I think there are still opportunities that that are there to be had, as it were, on the African continent, and there's a lot to be said for us remaining African focused, given that we've invested heavily in the intellectual capital we've acquired about operating on the African continent, which I believe gives us a competitive advantage over some of our peers. If we were to go to Australia, for instance, or to South America or wherever else, I mean, we would be starting right at the bottom of the learning curve in terms of how do we operate in these new jurisdictions. And having made the investment already, we've got to capitalise on that. So, no, we're going to be focusing on the continent in the foreseeable future. But that, never say never. I mean, if a compelling situation came up, we may change it, but I can't see that happening anytime soon. 4
billion Aussie, you're very attractive to some of the other kind of mid-tiers. We've seen a few coming together of groups. The big boys are looking to work out how they can fill their boots in times like this. Do you see yourself as an acquisition target, or do you see yourself as an acquisitor?
Well, we're certainly not out with a for sale sign on us. However, obviously, if somebody came along with a compelling proposition that was in the interest of our shareholders, well, we would be duty bound to put that to the shareholders and not stand in the way. I mean, the idea of blocking bids because of personal circumstances or desires, I think that's a load of nonsense, frankly. If there's an offer there to be had, then, we will look at it. But, if you do cast your eye over the universe of people who might be interested in that sort of thing, it's a pretty shallow pool as well. There are not that many companies out there who would be interested in acquiring a company that has an all-African exposure.
Right, and let's go back to that perception. As you said, like, you've worked in Africa, I've worked in Africa, perhaps we've got a very different view, the ability to work in Africa compared to most. But let's talk about some of those things you talk about. We talk about, the inflationary component has not gone away for anyone, but Africa specific, supply chain risk, energy risk, security risk. How do you view those? And I know you're operating multiple jurisdictions, and maybe I don't necessarily want to be generic in this statement, but give us a sense of some of the things that concern you, and are those amongst them?
Well, look, all of those things concern me because they're issues we deal with every day. But if I was operating in Australia, for instance, I would have even more concern about labour, for instance, about turnover of labour, about the cost of labour, about green tape, red tape, black tape that imposed by the government. I would be very concerned about all of those things. Now, am I concerned about things in Africa? Sure. There's a rising, youthful population in most African countries, and the governments of these countries are very keen to find sources of revenue to invest in their youth. And mining companies are an obvious area of particularly when the gold price, for instance, is high, that the governments would look at us and say, geez, you can contribute a little bit more than what you're doing at the present time. So, yeah, look, that's something that is very much, that we think about. But it's not an unreasonable request, to be quite frank, if we are sharing those benefits with the people that fundamentally own the assets. So, look, there's lots of headwinds. I mean, security is a standing cost we have in Africa that people in Australia may not have. But of course, it sounds like Canada might need that shortly with the US going to take over Canada. But let's not be too fixated on that particular point. But I joke about it. But look, we all have our challenges, and we need to address those things. You can run a company well in Africa or badly, just like you can run a company well in Canada or badly. It just depends on what you do. I don't think it's necessarily jurisdiction specific, although it's fair to say that there have been some jurisdictions on the continent that have been more problematic than others. And look, we've got an investment in Sudan, which was going gangbusters, heading in the right direction until it wasn't. And that reversal of fortune there has cost us, in the sense that had that war not occurred, we would be very close to commissioning the Maya Sand project around now, and we would be adding that to our production profile. Now, that's not going to happen, but when we recognised that, we went out and we bought the Nyanzaga mine, and it is going to be bringing production online, albeit a couple of years later. So look, you've got to be willing to recognise the challenges, know what they are, work up, strategies of mitigating, and then go and execute fearlessly. And that's what we've been trying to do.
Is gold price one of the risks? You talk about you being long along the tooth, and you've seen these cycles come and go. But in the current market, is this gold price sustainable for some time, and therefore, how do you play it in terms of your hedging strategy?
Look, it's a difficult one, isn't it? I mean, it's hard to see reasons for the gold price falling in the short term. That is for sure. But do I believe gold is going to be at 2,900 for the next 20 years? I'd like to believe it, but I'm struggling with that one, I've got to say. Now, how does that impact our hedging? Well, look, there is a chance that the gold price will fall at some particular point in time. And so to mitigate against the impact of that, we are currently hedging a small percentage of our production. About 24% is hedged, and we're going to, come what may, we will get at least $2,500 an ounce for that 25%. Now we're getting, for 75% of our production, we're getting the spot price, 2,900 and whatever it is today. So we're giving away a little bit of that upside in order to have the security in the event that what has happened on many, many occasions in the past, i.e. the gold price falls. In the event that it falls, we are going to be in an exceptionally good position. And if I'm taking my role responsibly of managing shareholders' funds for the long term, managing the biggest risk that I can see, which is gold price, it's part of the business. I can't see how anybody can knowingly or willingly ignore their biggest risk if they're a professional manager.
And how do you play? You talked about dividends in there as well, and I appreciate what you just said, but you talked about dividends and dividend kind of policy there in an environment like this. Share buyback program you mentioned earlier, is that something that you do, and if so, to what degree? And in a market like this, is that the most effective use of capital?
Well, we believe it is at the moment, to a degree. And of course, at some point, we're going to say, well, actually, we can probably use that capital better by investing in certain things rather than necessarily buying shares. But look, this is the first time we've done a share buyback, and I must admit that, the last 6 months we've been learning how to use this tool wisely. And what we have been doing is using it to protect our share price against the vagaries that we are exposed to. For instance, what does happen periodically is that bad news will occur in the United States, which will impact the Dow Jones, be completely unrelated to the market and to Perseus, but nevertheless, Dow Jones will go down when the Australian market opens. The ASX 200 goes down because it's tracking Dow Jones. Now, if we were to be standing by and watching that happen, our share price would fall with no reason, but no valid reason, until people realised, it's index related, and then it would start climbing out of the hole. If we can sit in the market when that occurs and stop it from falling, then we're giving ourselves a higher base from which to leverage when the very good news that we've released today, for instance, comes out, and we should be better placed going forward, which means that our shareholders receive a benefit from the spending of that money. So there are various ways of using the buyback mechanism, and that's something that we're progressively learning about how best to do that and how we can extract most value from that tool that's available to us.
Okay, so that's something to be monitored, but as you say, there are outside factors which kind of drive the share price. It's a hard one ultimately to measure, but let's see how you get on with that one and see if you come back to it. But coming back to a phrase which you use, and I think you like to use, you talk about this emphasis on a disciplined value creation. In that case, what are the KPIs that you use to measure the success delivering against that statement?
Well, we don't publicise in detail those metrics because that puts us at a significant disadvantage. But clearly, we try to generate a return on funds employed that is superior to what we would get if we had the money on deposit. Let's just say.
Okay. Return on capital invested.
We don't, go through this in enormous detail because the reality is that there's a lot of metrics that you can employ, and particularly when you start looking at long life projects, things like, IRRs and NPVs and all this sort of business have got fairly little relevance after about 7 years. that doesn't mean that the remaining 20-year mine life's got no value at all. It might do in an NPV calculation. So there's a series of different metrics that you need to examine. Then at the end of the day, you weigh it all up, and I guess that's where the judgment thing comes to play too.
Tell me this one, and again, this will be a bit more emotional one in the sense that you talk about having social license in jurisdictions, and everyone has done, and it's been particularly accentuated in the past few years. But do you think now with this kind of political backdrop, we're saying, say out of the United States, what we're starting to see in Europe, reaction to the past four or so years, there's going to be, I guess, less of an emphasis on that, less also opportunistic. So when I'm trying to think of the right word here, got to be careful. There are lots of examples and lots of instances, and when I speak to CEOs sort of off camera, they know that maybe some of these NGOs are perhaps being less than honest in certain jurisdictions because they are against mining more broadly. It's not necessarily purely anti-fossil fuel thing, it's an anti-mining thing. So do you think you'll see less of that? It's a bit more of a kind of realistic engagement on the social license side of things?
I don't think you'll see less of it. I mean, if people can see that there's an opportunity for make money for themselves, they'll continue to do that, and that's what a lot of NGOs do. So we're not too concerned about that. I think our dialogue takes place with host governments directly and with host communities, and we've got a pretty fair idea of what people think and what they really want, to the extent that they're frank with us. So that's what we work on the basis of, and it's about equity. It's about fair and equitable distribution of benefits. That is part of our mission statement, in fact, to generate benefits for all of our stakeholders in fair and equitable proportions. That's the mission of Perseus. Now, the very difficult piece in that is what is fair and equitable. What I think is fair and equitable may not be what my host government thinks is fair and equitable. But at the end of the day, you've got to cut the cake up, and you can only eat it once. And, as I say to people, if you want a bigger slice of that cake, who are you going to take it from? You're going to take it from the employees, you're going to take it from the community, you're going to take it from us. Well, if you're going to take it from us, we won't invest. So let's be clear about what the rules of the game are up front, and then we go from there. So, I think having, natural dialogue with people, understanding where they're coming from and what their needs are and what their ambitions are is extremely helpful in terms of deciding whether you want to be involved or not, because some of these things may run quite counter to what your fundamental beliefs are.
How do you grade this half-year results? How do you think you've actually done? Where's the room for improvement, and where can you sort of slap yourself in the back and say, actually, good job, team, good job?
Well, they're a pretty solid set of results. There's no two ways around that. Can we improve? Well, I hope so. We're always striving to. Let's just see what happens. But we've got plenty of work ahead of us. We've got to keep our production levels up. We've got to keep replacing what we deplete on a daily basis. We've got to try to keep the inflationary headwinds at bay. And all of those things are, day in, day out challenges that we deal with. I just hope we're successful in the future and can deliver more results like this one.
Jeff, appreciate your time today. Speak soon.
Thank you very much for your time.